Given OPEC's decision to essentially keep the taps of production full, that $100 per barrel price is not going to come into the market anytime soon. That at least is a general consensus after OPEC's meeting in Vienna. We'll be looking at the impact this will have, however, on African crude producers, with Nigeria, of course, the biggest on the continent, right in our crosshairs. Welcome to this edition of Global Business Africa. Here's what we have lined up for you. The curtains fall on another edition of the World Economic Forum on Africa. And Zimbabwe to keep its population employed by complicating the retrenchment process. Now then, the Organization of Oil-Producing Countries, the cartel known as OPEC essentially, has agreed to stick by its policy of unconstrained output for another 6 months. Now, the meeting that was held in Vienna earlier today noted that oil prices had rebounded by more than a third after hitting a 6-year low, $45 a barrel in mid-January. And they, as far as they're concerned, saw very little reason to tinker at all with their current strategy. Oil prices rose by nearly $1 a barrel after the decision was announced, paring some of this week's losses. Friday's decision defers discussion, however, of several tricky issues that are set to arise in the coming months. With members like Iran and Libya, for example, preparing to reopen the taps and put their muscle, as far as production of oil is concerned, back into the market after years of diminished production. The group will be meeting once again on the 4th of February.
The OPEC unanimously agreed to keep the ceiling, which we agreed upon previously, of 30 million barrel a day, and watch the development closely and respond according to the development.
The market will not realizing the $100 anymore. The fair price as we see it now. You have Syria is out, Yemen is out, Libya is out. We have problem in Iraq, but does not affect the production. You have the other Middle East, but does not affect the production. So the supply is smooth going, so there is no risk factor at this time whatsoever. That's why you see the prices down.
Right, oil politics, of course, is a fairly interesting topic, but let's move on to the World Economic Forum in Africa. Now, it's believed that African economies as a whole, all 50 plus of them, are missing out on billions of dollars in tax revenue from international corporations due to a combination of things. Fraud, especially from trade misinvoicing, tax avoidance and tax evasion. There's a difference between those two. As Angelo Coppola reports, delegates to the World Economic Forum on Africa are now calling for an international, coordinated approach to end these practices.
Current corporate tax compliance in some businesses flies in the face of the latest generation of good business principles and sustainability, and it seems that there are still businesses who choose short-term benefit over longer-term survival. And increasingly, organizations, though, are calling for international action to stop this.
Oxfam is calling for an international, an intergovernmental tax body under the auspices of the United Nations, where all countries can sit together and agree the new corporate tax rules.
While that may take some time to get off the ground, another organization is taking a different approach.
I think we really need to zone in on the logic of profit by any means necessary. And we need to speak back. And I think that this is why the Africa Not for Sale campaign is really significant, because we are really galvanizing young people.
Some organizations are claiming the moral high ground for good business reasons.
We trade on trust, so it's very, very important to us that society trusts us. Society may not like us, but we need society to trust us. And an important element of that is the payment of tax. Now, we would encourage all players to do their bit insofar as tax compliance is important, because it goes to the heart of being a corporate citizen, and it goes to the heart of contributing to, as you correctly point out, shared growth.
I think we need to keep ourselves honest in spaces like these, like the World Economic Forum, and talk about the contradiction. And that if we are serious about inclusion, and if we are serious about sustainable development, then we really need to ensure that we close that gap between rhetoric and practice.
Part of good corporate governance is tax compliance. And while many will do what they can to keep their profits up by avoiding tax, it's morally indefensible. I'm Angelo Coppola for CCTV at WEF on Africa in Cape Town.
We're still in South Africa. That country's president, Jacob Zuma, says the continent, or the continent's countries rather, ought to implement the recommendations of a Thabo Mbeki-led African Union panel on illicit financial flows.
We have actually established a, a small grouping to look into this, and I think it's led by former President Thabo Mbeki. He has provided a report already, which tallies with what the UN is saying in terms of how much funds are going out. This is what is going to be discussed by the AU. What then do we do? We are again going to need the contributions to those who handle finances, because what has become clear is that on both sides there's something going wrong. To those countries where the money is going and where the money when the money is taken from, and perhaps to some degree some collaboration. So we've got to address that issue so that we can utilize those funds to be. In the past, in Africa, I don't know in other places, we used to say many rich people in Africa, they've got their purse somewhere in Europe. Now why don't you have your accounts in Africa so that those funds could be used in Africa, but not encouraging taking the monies of the people.
South Africa's present there earlier in a session, of course, moderated by CCTV's Beatrice Marshall. Now, let's head over to Cape Town, South Africa. Angela Copeland, of course, has been covering the World Economic Forum for us over the last 3 days. Angela, walk us through the highlights of the final day of conversations today.
Well, Raman, the highlight for me had to have been the prayer at the end closing ceremony by Archbishop Desmond Tutu. He appealed to the heartstrings and made a plea for people to work together to solve the issues facing the continent, facing specifically the women and the children. Then, on a more somber note, there was a discussion around terrorism and the need to eradicate it wherever it appears. And one of the suggested outcomes or ways to do this was to actually eradicate poverty and unemployment. That was seen as tackling, that would probably tackle the terrorism issue. We also heard about the Africa Progress Report, where Graça Machel was in fine form and focusing on people, power, and the planet. And then, I guess, for me, probably one of the biggest things was the fact that Rwanda has been announced as the venue or the country that's going to host WEF Africa 2016. Raman?
Indeed. Let's focus, however, on one of the other issues that cropped up today, especially in one of the last panels of the day, the gap between actual risk in investing in Africa and the perceived risk. Ernst & Young's Africa Attractiveness Survey covers that year in, year out. Gordon Brown mentioned it once again today. Why does that gap still persist?
Basically, Raman, you know the answer to this one as well as I do. If people invest in the continent, they know where the risks are, and in any country for that matter, they know where the risks are and they know how to mitigate them and how to work around them so that they make a profit for their shareholders and they look after their staff. For people and investors who aren't invested in a particular country or anywhere on the continent, they loathe to get involved purely because they don't have enough information. And if they were really that excited on the returns that they could possibly get, they'd probably go and do the research and find that, like any business, in any continent, in any country, if you look at and identify the risks, you know what they are, you can mitigate them, and you can still make a business out of it. So it keeps coming up, and it's probably going to carry on coming up until investors understand that each country is different here, and investment opportunities abound, provided you know what the risks are. Raman?
Indeed. There was also lots of concern expressed at the event about the sheer scale and the risks of sovereign dollar-denominated debt that quite a few sub-Saharan countries have taken on in the last couple of years. Tell us more about that.
Okay, Raman, I'm sorry, I lost you for a second. I didn't hear the question. I've got a really bad line here. Can you just repeat for me, please?
Sovereign dollar-denominated debt, all these euro bonds that African countries have been issuing, there's been a lot of concern about the ability to service that debt. Ghana, of course, being a poster child for what can go wrong. What sort of concerns were delegates raising?
Okay, Raman, it's a question of the glass is half full and half empty here. The Rwandan central bank governor subscribed to the half full side of the equation, and he's suggesting that 10 years ago, investors looking at countries on the continent would look at their high levels of debt and say, no, that's too much for us, we'll move elsewhere. That's gone away. In fact, the central bank governor was saying that there are many countries on the continent that have a 50% or less debt level to GDP, and that's an opportunity because they can probably take on more debt and service it properly. So it's there, it's an issue, but he's also suggested that countries should link infrastructure with trading platforms and improving liquidity in order to get the capital markets that are in the continent more efficient so that they're going to attract more debt. Rahman?
Indeed. One final question for you, Angelo. Efforts to set up a tripartite free trade area linking EAC, SADC and COMESA will commence this month. What sort of obstacles do companies represented at WFC in this latest effort?
Well, most businesses have the same issues wherever they are. If they're working cross-border, they want to see consistent economic policy between countries that they're operating in. They're also looking for consistent and seamless cross-border movement, first of all for their finished goods, and probably more importantly for people, staff, either low-level educated or highly educated staff moving between countries. And they want to see that it's essential for them. One of the suggestions put forward was that there should be more regional integration, especially around the smaller economies, so that they can work together to attract bigger investors to come in. And then they're suggesting each country probably produces a particular item in their value chain. And then finally, there was a suggestion that banks perhaps should be incentivized to finance and fund those SMEs that are critical to any country's economy. Rahman?
Indeed, we'll leave it there for the time being. Thank you for your input. That's Angelo Coppola, live in Cape Town, South Africa. Of course, he's been part of the team covering WEF, the 2015 version of WEF Africa down there. Now, let's go back to our lead story, OPEC's decision to essentially leave that unconstrained output policy firmly in place. Remember, way back around May, April, output from OPEC peaked at a multi-year high of 31.2 million barrels of crude a day. Let's see how the markets have responded to this. We're now joined live from London by Miriam Bemard. Miriam, the UAE's energy minister says November's decision to not cut output was the right one. But to what extent really has OPEC succeeded in battering American shale into submission?
Well, Rahman, no one wants to admit they're wrong, right? Oil prices have rebounded since hitting a 6-year low of $45 a barrel in January, but have lost more than 6% this week alone. So one could argue that they haven't been successful in pushing back on shale production. You know, many experts are telling me that market share should have been defended more aggressively, Rama. And what we're seeing is a real shift in the energy sector. Budgets of exporter countries have lost more than $100 billion of spending on new global projects, not to mention non-OPEC suppliers who are cutting prices to maintain that competition. In fact, the common thought is that OPEC hasn't accepted or really understood that a slowdown in China and Europe may be the new norm, and that's why we're not seeing more aggressive action.
Indeed. I should also point out that Deji Bedmus joins us now live from Lagos as well. Deji, this glut in supply and OPEC's decision combined really can't be good news for Nigeria. How are authorities in Nigeria responding to the decisions made earlier today in Vienna?
Well, thank you very much, Rama. There's been no official reaction yet from the Nigerian government. As you're aware, the country is yet to get a petroleum minister. We do not know who that minister would be, even though there are suggestions that the President Buhari, might decide to occupy that position, keep it in the presidency. So there's been no official reaction yet, but there's no question, as you said, that this is no good news at all for Nigeria, because it further compounds Nigeria's problem. People had, or analysts actually, had been expecting that there would be some kind of adjustment, but then with the current oil glut you have, well, difficult times continue for Nigeria. We just only have to hope that you know, prices will continue to rise, even though we know they're rising gradually. So authorities will continue to pray that, you know, we continue to have this rise in prices, but then the key to all of this is that the country needs to diversify its economy, Rama.
Indeed. Miriam, coming back to you, though, let's focus on one of the less spoken about aspects of today's meeting. Iran coming back into the market. Between the talks with the US on lifting sanctions and getting its nuclear program more or less on board, how soon can we expect Iranian crude to get back into the market?
Well, Rama, some would argue that, that that OPEC powers don't want Iranian oil back in the game to begin with. And others argue that it could actually add to a global oversupply of crude that's been weighing on markets anyway. And this week, of course, Iran's oil minister has once again hinted from the meeting in Vienna that the country would boost supplies by 1 million barrels a day within 6 months of sanctions being lifted. But others say that that's really unlikely. So what we do know for sure is that once Iran is back in, it will be disruptive for the markets. We could see oil prices fall further, hovering back around that $45 a barrel mark that we had seen last year. But that in itself might actually trigger a production cut by OPEC.
Indeed. Deji, at the end of the day, the U.S. isn't buying a lot of Nigerian crude oil, and some OPEC members like Saudi Arabia have been busy offering deep discounts in Asian markets to India and to China. So where does that leave Nigeria? Where's the country selling its oil these days?
Well, of course, Nigeria has actually turned to Asia. As a matter of fact, India and China, to be precise. Sometime last year, India actually stepped in as the single largest importer of Nigeria's crude. But then there is a problem also there, because in December last year, we saw India cutting down on Nigeria's crude imports by about 38%. And that's a serious problem. And we're also seeing that slow down this year as well, because India is now turning to Latin America, where it is getting cheaper oil. And we're seeing that with China as well. And then we're seeing Saudi Arabia actually coming into that market as well, countries from Central and South America coming into the market. So you have this glut. They're all coming in with cheaper oil, even though Nigeria's oil is actually light and sweet. But then oil refiners in Asia, we know, can refine whatever oil is brought to them. And because they're getting it cheaper, then that means some kind of bad news for Nigeria. So for now, we're having a difficult time getting buyers. As a matter of fact, if things continue to go like this, then we're in for more trouble, especially as we understand that Saudi Arabia also intends to go in there, despite the fact that Nigeria is given some discounts. The same way Saudi is given discounts, we still are not getting the actual amount of buyers we should be getting at this moment. So it's actually a tough one for Nigeria.
Indeed. We'll leave it there for the time being. Thank you both for your input. Deji Badmus live in Lagos, and of course Miriam Bemard live in London. Based of course on that discussion, you certainly don't want to be the next finance or oil minister in Nigeria. Tough times ahead for that country. Let's move on to Zimbabwe. The Labour Ministry there plans to amend the country's labour laws to make it harder for companies to sack their staff. As you're about to see, the government argues that the changes aim to curb what they describe as arbitrary retrenchment and bully tactics.
The economic crunch is taking its toll on companies here. Many have been forced to shut down or scale back their operations. But in doing so, government accuses them of giving workers a raw deal. Zimbabwe's current retrenchment regulations were crafted back in 2003. They are clearly no longer relevant to the current economic situation that has seen more and more companies pushed to the brink. And as those companies either shut down or downsize, they're pouring more and more people onto the streets. And that is a situation that is becoming increasingly unsustainable. That's why government wants to make it harder to retrench. Struggling companies must justify laying off workers, especially those on the shop floor.
Why are you retrenching at the bottom? And yet nothing is happening for companies that are top heavy, and where you've got salaries that are paid, you tend to have higher amounts at executive level. And therefore they are trying to amend the retrenchment regulations in such a way that for a company to have approval of retrenchments, they must also submit details of executive salaries, profile what has been happening at the top.
Zimbabwe has been rocked by cases of corporate excess, where executives enjoy massive packages as much as $250,000 per month in the case of a former CEO of one medical aid society, while lower-level employees get part payments. However, the push for more stringent retrenchment laws could have some adverse effects.
Voluntary liquidation, judicial management, or simply abscondment, because this has happened, Recently, we have 2 or 3 construction companies where simply the owners have just absconded. So we need to look at the intention vis-a-vis those. And the history of judicial management in this country has shown that it is the workers that suffer.
The solution, according to experts, is to come up with a tripartite social contract negotiated by labor, employers and government. It will agree on wage increases or reductions and review terms and conditions of service in line with the prevailing economic environment. Farema Mutuya, CCTV, Harare, Zimbabwe.
Right, and a quick run through the markets here for you now. Some interesting numbers coming through across the board. Gains in Nigeria, gains in South Africa. The NSE 20 in Nairobi ending the day up to 10th. But remember, in the wider context of where it's been this entire week, we're actually closing in the red for the entire trading week as a whole. Of interest, however, for those of you who are watching financial stocks, especially Kenya, look at KCB. It signed up 1.8 million mobile banking clients, and it is on course to increase that fairly strongly. Should have an interesting effect, of course, on their net assets moving forward. A ban on travel with animal trophies in some airlines has elicited heated reactions. We'll tell you why. And Aliko Dangote's relentless march across Africa continues, this time in Ethiopia.
Effects of the austerity measures are evident and were expected. Egyptians, however, seem to be patient about it. But El-Sisi told government he wants to control the prices promptly before people's patience runs out.
Welcome back to the program. You're still watching Global Business Africa. South Africa's game hunting industry argues that a decision by 2 major airlines that fly into and out of South Africa to ban the transportation of hunting trophies is very bad for their business. South African Airways and Emirates both have implemented a ban on international hunters flying their wildlife trophies home with them. However, as Julie Shire reports, unlike the game hunting sector, wildlife conservationists are very, very happy.
South African Airways' decision to place an embargo on the transport of elephant, rhino, lion and tiger hunting trophies comes after SAA Cargo experienced a problem with misdeclared hunting trophies and was heavily fined in a foreign country.
This was a necessary mitigation on our part. We have taken a decision to place an embargo based on things that we are experiencing on the ground. We will at the same time initiate a process of a conversation with all affected stakeholders, including the hunting associations as well as government, so that we are able together find lasting solutions to what we see as a challenge ahead of us.
This decision comes at a critical time for the hunting industry in South Africa, as 2015 hunting season has just started.
Our position is that the ban was never well thought through. It wasn't based on facts. It was really an emotional decision as far as we're concerned. By putting an embargo, because an illegal activity takes place, we'll never ever address that illegal activity. So we do have a very, very well-regulated system in South Africa, both for legal hunting and for the legal export of trophies that were legally hunted in South Africa.
South Africa's hunting industry depends heavily on international hunters who pay a lot of money to hunt in game farms.
I think it's going to affect the market very badly, because if a serious hunter comes and wants to shoot at an animal here in Africa and he can't take the trophy home, he won't come, he won't shoot it. And I mean, hunting is a sport, it's like any other sport. And I don't think it will affect the conservation whatsoever. As a matter of fact, it will protect it.
But some conservationists have applauded the embargo.
Pause is delighted at the decision taken by South African Airways to place an embargo on the transport of trophies out of South Africa. It's very clear that most of the lion trophies are actually trophies of those lions bred and shot to be hunted. And the decision to take a significant step to end this cruelty is commendable.
It's estimated that approximately 1,000 lions are killed in South Africa each year for trophy hunting.
For now, big game hunters will have a hard time bringing animal trophies like these ones back home. Julie Shire, CCTV, Johannesburg.
Aliko Dangote's restless march as far as investment is concerned right across sub-Saharan Africa continues. This time, he's opened a cement plant in Ethiopia. Girum Chala was there.
This is the latest cement plant that the Dangote Group has launched in Africa. The factory costs more than $600 million to put together and is expected to produce 2.5 million metric tons of cement.
Currently, 18 companies, including Dangote, are engaged in cement production, and the country is expecting 17.15 metric ton per annum. We are excited about the timely completion of the project and economic prosperities of having such a huge company.
Demand for cement has outstripped supply in Ethiopia following a booming construction sector. Though the existing cement factories produce a little more than 5 million metric tons of cement per annum, the demand is far from being met. Aliko Dangote, Africa's richest man, according to Forbes magazine, says his factory has the capacity of satisfying the current demand.
The youth, who constitute 55% of the Ethiopian population of 90 million Ethiopians, will benefit immensely from this project. Our investment is a sure and solid step in the journey of transformation of the Ethiopian economy from agricultural to an industrial economy.
For a country with lots of aspirations to industrialize, the opening of this world-class cement plant has far-reaching implications. Ethiopia's Prime Minister Haile Mariam Desalegn used the opportunity to assure upcoming investors from within Africa and the world that Ethiopia will be their right business destination.
We leave no stone unturned to make this country a suitable destination for foreign investment and adequately conducive for domestic investors alike. I am hopeful the continued interest and presence of self-made industrialists such as Aliko Dangote in investment projects in Ethiopia's diverse sectors and their successful experience can and should go a long way in encouraging local investment.
This plant has been constructed by Chinese companies who are still on site. Currently, there are at least more than 3,000 employees working at this plant. As part of his aggressive investment plans within the African continent, Aliko Dangote promised to build yet another same-size cement factory here in Ethiopia. That means more job opportunities ahead and business chances for Ethiopians. Group Dara CCTV, Mugar, Ethiopia.
Best part about that story will be finding out how Kenyan cement makers who've long enjoyed East Africa as a playground will react once that thing comes online. Quick run through commodity prices here for you. Brent crude not exactly having an excellent end to the week. It started Monday around 65. However, in the wake of OPEC's decisions, around 62, just under 63 or so. But also remember the ripple effect it's having. The Angolan central bank today devalued that country's currency by about 6 percentage points, which is not exactly a small amount of change. But that's where we wrap up this edition of Global Business Africa. As always, we value your feedback. globalbusinessafrica@cctv.com is the email address to use. The news continues, as always, on Facebook and on Twitter. We'll see you right here on Monday. Thank you for watching.